Okay, it's Sunday, and this is just a quick update video on the Fury Road trade, or the 111 or 112 trade. So about just like over a month ago, I put out a video where I showed the concept of this trade and what it was about it that bothered me. And it basically has to do with the downside risk. And I've got a lot of response from that video, and it's really interesting to see the types of responses I get. A lot of people said, oh yeah, I'm glad someone's actually pointing that out now. I thought the same thing. Some people just totally disagree. Some people are just in denial, like they just sort of like turn their head and look away and like it doesn't exist. And some people are just plain pissed. Other people who didn't really understand how options work and they're sort of new, I think sort of had their eyes opened a bit to the potential risk. Anyway, the whole thing with this trade with me, I love the idea of this trade, and it's just that downside is just really glaringly obvious to me. There's a big problem there. And rather than bash the strategy or just throw it completely out the window, I'm more interested in finding a way how we can take the strategy and just kind of tweak it or add some things to it to make it a safe trade, a really safe trade. A trade that doesn't have that huge, naked risk to the downside and won't totally blow up your account on a big move down. So the last week I made a video on a concept called the freeze adjustment. And the freeze adjustment is this strategy that I learned in this group that I keep referring to. It's this amazing options income trading group I got involved with a couple years ago that totally changed the whole game for me, my whole trading game. And there's a ton of value in there. It's ridiculous the amount of value that you get. And if you're serious about this way of trading options for income, I highly recommend that you get involved with this, or just contact me and I can point you in the right direction. And a lot of the stuff they have in there is it's so unique and so groundbreaking and different from what anyone and everyone else out there is teaching. And again, I joined them several years ago, and it was the absolute best investment, literally the best investment I've ever made. The returns from what I've learned in that group and what I continue to learn is off the charts. There's really no other investment I've ever made that has beat it. And as much as I'd love to, like with a lot of their stuff, I just can't give it away because it's not mine to give away. It's their IP. They've spent years and blood, sweat, and tears developing these strategies and continuing to develop these strategies. And it would just be super uncool of me to just like plagiarize it, put it out there, pass it off as my own, or just give it away to everyone and their mother for free because it's not mine to give away. But what I can do is I can point you directly to the source. I can show you exactly where to go to find it, where to learn it. I can personally help you become a member of the group, help you get started, show you where all the good stuff is. These guys, they have a huge archive of past trainings with really unique strategies and methods that you've never seen anywhere before. And again, if you're really serious about this type of trading, there's nothing else out there like it. It's I call it the creme de la creme. And if you reach out to me, I can totally help you get involved. Anyway, I bring that up because the last video I made is this freeze strategy where it's this really simple tweak, really simple adjustment you can make to these types of trades or to any type of trades that will just freeze the position and like in place. Like say there's a big down move going on or like a flash crash and you can't figure out what's going on. Is this something that's going to last long term? Is this serious, or is this just kind of a weird anomaly like for the next hour and it's going to bounce right back? What this strategy, the freeze, can do is you can just take your position and freeze it. It just freezes all the Greeks, or it brings all the Greeks down to like zero, freezes the position so you're not losing any money and you're not really making any money either. You're just kind of frozen in place, which gives you the opportunity to catch your breath, not be so stressed out, think reasonably, try to figure out what's going on and the best way to move forward. Or in other words, you're not just under the gun having to make a super fast, emotionally filled decision. You can actually freeze the position, freeze time, get your wits about you, which can allow you to make the best decision how to go forward. So if you missed that video, you look for the thumbnail. I'll put links to all these in the description below, but the thumbnail for that one looks like this. It's the freeze, and I tell you all about the freeze, and I show you how the freeze is used with my main bread and butter strategy that I learned from this group, what that looks like and how that works. And I also give you a version of the freeze that you can use with this particular trade, this 112 or the Fury Road trade, that will essentially do the same thing. It'll just freeze the position, super simple adjustment to make. And I show you like my own version of it that you can just copy and see exactly how it's built. You can see the strikes, the expirations, the amount of contracts, all that. So that was the freeze. And the freeze is just like a reaction strategy to a big move down. The ultimate way to protect these type of trades is to have the insurance already in place, because these are Black Swan hedges hedges. And I think the whole definition of a black swan event is an event that you have no idea. It just kind of comes out of the blue. There was no way you could even predict it. So in that case, you need to have insurance already in place. You don't have time to go out and get insurance. Or if you wait until the thing happens, there's going to be so much mayhem and chaos going on that not only will you not be able to think clearly, the insurance is going to be ridiculously, outrageously priced, and it's just going to be a bad scene. So the best way to be prepared for a black swan event is to have your black swan insurance or your black swan hedge already in place. And one of the coolest concepts that this group, this creme de la creme group teaches is how to build black swan hedges that can be embedded within strategies like this, or that can be a standalone strategy like this, or an added black swan insurance strategy where you can be overinsured if you want to be super safe, or how you can create black swan hedges for a whole portfolio of different strategies. And the best part, my favorite part about all of this, is that it teaches how to build self-financed black swan hedges. Because of course, if you're going to put a trade on and you're going to hedge it, it's going to cost you some money. Then you can reach the point where is it even worth to put the original trade on, depending on how much the cost is. So if we take a look at this is just a basic Fury Road trade or 112 trade. Now you can see where we're trading right now. We're right here. That's where the underline is. This is SPX. And you can see that we have a profit up here from this little corner of this boxy tint area all the way up, that if it finishes trading anywhere in here all the way to the upside, you can make a profit of 1,055. That's how this is set up. And so, but you can see this big drop off. So this is the problem. I mean, this is this is the nakedness. This is going to cause a lot of pain in a down move, especially with a negative Vega trade like this one is. So let's just look at buying some insurance. So let's just say if we were to buy one extra put right here, if we were just buy one extra put, you can see we still have the issue there. We're down $100,000 right here with one put applied to this, and that put cost us about $540. So now our total profit potential up in here has decreased from $1,000 down to $515. So it's still profitable, but our downside hedge is not that's not really doing that much for us. There's still a lot of pain here. So let's add another one. So now we're going to buy two, and that just kind of chops off that downside hedge down here. It's like a put credit spread now. And so your maximum risk is 46,000 down here, which is a lot, but you might have some time in here to get out of it before it were to reach that in a black swan type of event. But still, 46,000 is not that's a lot of money. And what it's done to the upside here is that now we have no more profit left at all on this ledge here. We've spent $1,000 on these two puts to give us some black swan hedge protection. Not even that great a black swan hedge protection, just kind of a stop the bleeding protection. Where it gets cut off here around $45,000, $45K. But we've used up all of our profit potential up here. So now there's no profit potential at all. In fact, the best case scenario is that now we lose $25. We lose $25. That's our best case scenario, unless we can get into this tint area. But this tint area is really not going to come into play until the pretty much the very end of the trade. And the Black Swan hedge is, it's better than it was before, but it's not great. We're looking for more of a Black Swan hedge like this. And this is just 3 puts added now. So this gives us, now we're starting to get somewhere with the Black Swan hedge, because even with a drop down, with a crash down, the volatility is going to come up in here. And although it's not ideal, and there's way better ways that I can show you to create these type of hedges on these trades or embed them within these, if volatility were to go up, at least the pink line is going up now. So I'm taking the volatility up. You can see that pink line raising. So at least in this case where we have this V shape down here, we're getting closer. We're on the right track, but it's still not ideal. There's still a way better way to do it. But you can see the cost of this. So we've had to create this risk graph. We've had to buy 3 puts, and so now our best case scenario is that we're losing 565. So what's the point of the trade? Trying to apply this type of a hedge to the Fury Road trade or the 112. It's just kind of what's the point of it? Just why even put the trade on now? So that's a problem that we run into when we're trying to hedge one of these type of trades. So one of the solutions, there's several solutions, and I'm going to make a couple of videos that show the different things that you could do with these. But today's video is just going to be on one of them, and it's what I call the self-financed Black Swan Hedge. Basically what it is, it's a way to get an insurance policy, a hedge trade on that can stand alone by itself or that can be embedded within one of these trades that doesn't take any profit at all from these trades. You can keep the original amount that you had up here, the 1,000 credit going all the way up. You can keep this little boxy area and you eliminate this horrible, scary downside risk. So you get all the benefits of the original trade, plus you get a great Black Swan Hedge insurance policy or hedge strategy that can be embedded within this, or that can be just a standalone outside of it. It will give you a great downside profit potential in the crash that completely changes this trade from a negative Vega trade, which is bad, to a positive Vega trade, which is good in a downside crash. And this is a concept that is taught in that community, that creme de la creme community that I want to introduce you to. And essentially what it is, it's a trade that I call the pre-built self-financed Black Swan hedge. And it's a way to build a hedge, a super powerful hedge that will make tons of money in a crash. But the way that it's constructed and the particular order in which it's built, not only can you build one of these that costs you nothing, it can be one that can produce income, it can produce a profit by itself. So in this case, let's just take a look at these. This is just 3 puts by themselves. And this is a nice hedge to the downside, but the cost is $1,620. So what I'm talking about is a Black Swan hedge that has the same sort of effect as this, but instead of this expiration line costing us $1,620 at the bottom here, all the way up to here, we're going to lose $1,620. That's just the cost of the options. That's the cost of the hedge. Instead of that, we can get the same type of a trade that's self-financed, and it just has to do with the particular way how it's built. And it's actually ridiculously simple. It's just kind of unorthodox. It's just sort of like when you see it, you'll think, oh man, why did I think of that? Of course. It's just out of the ordinary. It's sort of like it makes sense once you see it built, but before you actually know how to build it or construct it, it's most likely a trade and a solution that you would never come to on your own. This is the type of strategy that could have been like kind of accidentally stumbled upon. And again, it just has to do with how it's built. There's different components to it that you put on at different times with different expirations, different deltas. It's like a step-by-step, simple to follow formula. You do this first, then you do this, you do this, you do that to construct the thing. And then once it's built, you can actually have a Black Swan hedge trade similar to this that you can embed into the Fury Road trade or the 111 or 112, or you can use for any other type of strategy that you have in your portfolio, or even you can just use it as a Black Swan hedge against like a normal portfolio of stocks. But the super cool thing about it is that it's a trade that can be an income generating trade on its own. It can be a profitable trade just by itself. So not only is it providing an amazing downside hedge where you could just make a ton of money if the market were to crash like in a Black Swan event, you can see it just takes off to the upside and keeps going. 200,000, 300,000 on the upside. Not only is it providing a phenomenal Black Swan hedge, but by itself, it's an income generating trade as well, which is like the really cool part I like about this whole thing. So essentially you're putting on a Black Swan hedge that can protect your entire portfolio of trades. That also makes money. It doesn't cost you money, but instead generates profits as well. So let's take a look at what this would look like. So here's an example of what this trade could look like. So here's an example of one of these. And this is just kind of an example I put together based off of one of the training sessions in this group goes through this. And it's a real live Black Swan hedge that's put on to hedge any type of option strategy, any type of trading strategy, even like just a regular portfolio of stocks. But what's different about this is just the way that it's built. And this is a trade that's on not for a short period of time. This is a trade that you continue to churn and roll. It's like a machine kind of. It's a simple, super simple combination of steps that you do every so often, like for example, once a month. It's like a machine that you just continue to have this thing on, and you continue to build it stronger and stronger and stronger, and with more profit, higher profit, higher profit, higher profit. So it turns into a trade like this, where if you look at this blue number down here, this is the expiration line. And so if we come up here, no matter how high this goes, you can see that this Black Swan hedge, as it exists in this risk graph, the worst case scenario is that this trade is $11,190 profit. So this is floating entirely above the zero line. There's no way that you can lose with this. And that just, again, goes back to the combination of how this is made and the machine, simple steps that you do every month to just keep this thing churning and getting stronger and stronger and stronger with higher profits, building higher and higher and higher. So not only does this wind up as profitable income trade, at the exact same time, it's providing you all of the downside hedge you would need. So let's take a look at this now combined with that the Fury Road, the 112 trade. So let's look at the 112 trade again. Here it is. You can see this is the same trade we looked at the beginning of this video. This has a $1,000 profit potential all the way up. Has this little boxy area where you can get up to $6,000, but it has this unacceptable downside naked risk. But if you apply that self-financed or self-funded Black Swan hedge I just showed you, you wind up with a position that looks more like this. So in this case, you can see no matter what happens all the way up, this position now has, worst case scenario is a profit of $12,150. So there's no way you can lose on the upside. On the downside, you can see this pink line is the 0-day line. So if there was a crash down, we would just ride that pink line up. And you can see our trade here, if we were to come down 10%, we're up about $300,000. 20% down, we're up here to $1,617,000, which is just ridiculous. And that's without raising the volatility. If in a crash type situation, as I've shown in my other videos, the volatility would like spike and this pink line would go up, up, up. And again, the way that this exists, that this strategy is like a machine, something that doesn't run out or it doesn't end, because every month you're just making a simple adjustments on a schedule that keeps this thing always on, the hedge always strong, and the cost of it once it's built and running is nothing. It's existing entirely on the risk graph above the 0 line. So this is just one of the tricks and techniques that we can use. And this is a strategy that's taught in that community, the creme de la creme. And if you're interested in learning more about that, I can point you in the right direction. And again, this is just one of them. This is just one of the tricks and techniques that you can learn in that group. And it's a community, a program, and a training that I totally, completely recommend. So that's one of the ways how we can fix this problem with the Fury Road trade or the 112. We can create standalone or embedded Black Swan hedges that can be self-financed, so it's not going to pull away income from your main structure. And depending on how it's built, this one of these types of Black Swan hedges could fully protect not just one of these Fury Road trades or 112s, but a group of them, as well as any other option income trading strategies you may have in your account. So if you'd like to learn more about how to trade and put on one of these types of Black Swan hedges, or just this whole collection of strategies and hedging techniques where the potential risk is heavily focused on, isn't ignored, while still having the ability to generate excellent results. And I think results that outperform any of the other strategies out there. So if you'd like to learn more about this type of trading and how you can join us in that group, I'd love to introduce you to them. For option traders, it really is like nothing else I've ever seen out there. And I'd love to introduce you and have you join us. So if you'd like to learn more about that, just email me directly. Probably the easiest way to email me, just to simply go over to my website. I'll leave a link to my website in the description below. Just head on over there, sign up for my free email newsletter. And when you sign up for my free email newsletter, you'll get a welcome email sent back to you right away. Just reply to that welcome email. And in the email, just say something like, I'd like to learn more about the Black Swan hedge, or I'd like for you to introduce me to your group, your options income trading community, something along those lines. And I'll know what you're talking about, and I'll get back to you and we'll go from there. That's it for this one, and we'll see you next time.